Now, has the cycle for metal sector turned permanently? There are two challenges here. One, um, export tax on steel, and more could be coming if steel prices do not come down. But more importantly, is the fear of global recession. If there is fear of global recession, then metal demand should come down, metal demand comes down, prices come down, cycle reverses. That's the logical interpretation of how central bankers are trying to fight inflation. But what about stocks? Are stocks pricing in a lot of bad news? A 1500-1600 rupee Tata Steel has already become a 1100 rupee stock, came down to 1050 couple of days ago. Sale was at 140, 150, is now in double digits. So where are metal stocks headed? Let's discuss that with Pinakan Parekh, Executive Director with JP Morgan. He tracks this sector with a magnifying glass. He's been very bullish on metal stocks, and we've heard his views quite a number of times, and I'm sure our viewers have benefited because of that. So what is your understanding? The golden period for steel is over. I had started using the phrase on TV that steel is the new gold, but now I'm realizing gold is gold and steel is steel.
Yeah, thank you, Nikunj. So obviously, we are seeing right now a mini down cycle. What we need to understand is that globally, steel prices do come off starting April, May into September. There is a seasonal destocking, industrial activity slows down, prices come off, and then prices start moving higher post-October into Feb, March. So this is nothing different this time. We are seeing, at least in terms of price trends globally and regionally. Now, obviously, there's an export tax, very, very sentiment negative. Investors have taken it on the chin. The question over here is that are we at the end of the global demand cycle? Now, what we would highlight is that for metals especially, China is 50% of the demand. Chinese demand has been running negative since October of last year. At some point of time, once the lockdowns fade away, there is going to be policy support, and that will drive demand higher from here. And China is more than 50% of every metal. So to that extent, our house view at JP Morgan is still that metal prices should move higher. Stocks obviously are pricing in a very severe earnings contraction, which looks very, very unlikely at this point of time. So I think overall, strong cash flows, depressed stock prices, and still higher commodity prices support our positive view on metals as a sector.
Take that point forward. The last part of your answer, stocks are pricing in a earnings contraction, which is unlikely to happen. So why do you think stocks are pricing that in?
So a couple of things, right? If you take a step back and you look at ownership, this is a sector which had very decent foreign ownership, high retail ownership over the last 18 to 24 months. News flow started turning lower. And obviously, at this point of time, there is a very high degree of investor skepticism as to what policymakers would do in order to fight inflation. So if you look at it, across the board, when you look at commodities, Indian stocks have underperformed massively the global peers. So it is not as much a worry on the global commodity price cycle as a worry on what policymakers over a year do they do, and how does it impact earnings, and in the backdrop of ownership which was relatively high. So I don't think we need to worry as much about the commodity prices outside of India as to what happens within India. And over here, I think steel, for example, the policy action has been laid out so one can price it in and move forward.
Good morning. Now, what we've also seen are the balance sheets get healthy, the margins look promising, but the regulatory action which has been taken on, for example, let's say steel exports, what kind of a threat can that pose to capex plans? Many believe that you could see maybe capex plans being cancelled or being delayed since exports will be out of the equation.
The capital expenditure plans. It would be interesting to see how companies do they pull back on capital expenditure plans. So now there are two parts to it. One is existing projects. You're already 50, 70, 80% through. You're not going to put it on the back burner. You would want to bring them forward as quickly as possible. The second is new expansions and new projects. So what I think everybody would want to wait and see is how long does the policy action stay in place? Do we see at some point of time if steel prices cool off in India and globally, does the export duty reduce or come off? But I would be very surprised if companies were to go forward with newer projects if the export duty remains in place.
Do you think there is an argument to lower the multiples for both the ferrous and non-ferrous companies? There are some who believe that yes, it could be the multiples could be lowered by 10 to 15%.
So that argument would have been valid if the stocks were trading at normalized valuation multiples. Now, if you look at 1 year forward consensus earnings forecast, across the board consensus earnings are meaningfully lower than what the companies are earning today. And on those consensus earnings estimates, the stocks are trading between 2 to 3 times EV EBITDA. So to that extent, I don't think there is an argument for multiples to reduce further from where we are at this point of time.
What happens in a scenario when the recession happens in the world? Because ultimately, steel demand is a function of underlying growth in the economy. If there is a recession or if there is a stagflation, a very basic question, Pinakin, very basic question. What happens to steel demand if the underlying demand, steel stocks, if the underlying demand reverses?
Sure. So, I mean, if you go back, the historical playbook is about demand falls, prices fall, earnings fall, right? That is how every recession has historically played out in the past. The only difference this time is that the price cycle we are seeing at this point of time across commodities is not demand driven. It is supply driven. And the supply story started a few years back because of China, because of global underinvestment. So to that extent, if there is a recession and if demand falls, there are two questions we would need to ask. One is it a global recession in the sense that does Chinese demand fall even further from here? Or is it a Western world recession and Chinese demand holds up? Then the impact would be far lower. The second is supply. There was no additional supply even where prices were very high. If prices were to pull back, will global supply even reduce further from here? So the point we are trying to make is that even in the next recession, it looks unlikely that margins would revert back to what we saw in the previous down cycles, simply because there has been years and years of underinvestment.
Okay. The other moving part is the Russian steel is not there in the world. I've been told that Russian steel is the most efficient, Russians have the most efficient steel capacity. If there is any change on the war front, and if the Russian steel comes back, could that have an impact on the underlying demand, supply demand trend?
Sure. So again, we would not like to comment on individual countries and on the conflict, but what we would highlight is that when talking to investors, the feedback that we have received is a de-escalation will not necessarily translate into normalization. So there has been a meaningful reduction in steel supply from the key exporting countries. The 5 big exporting countries globally are China, Russia, Ukraine, Japan, Korea. India is a very small one, and you have seen either a reduction or an export duty in some of the countries. So the seaborne steel market supply has only been reducing over the last few years, and that does not look like meaningfully changing anytime soon.
Where does cement fit in? We can argue both ways for cement. Pressure on raw material, but demand remains intact.
Sure. So we have been not been very positive on cement as a sector, and we still like metals. And the view being that both the sectors are facing cost inflation. Cement is facing very severe cost inflation, and our view is that thermal coal prices are unlikely to come off anytime soon, simply because what's happening with gas in Europe, which essentially pushes up thermal coal prices. Companies have had limited ability to pass on the higher coal cost, and that ability has further got crimped given the policymakers, focus on inflation. In this backdrop, if you look at consensus estimates for cement, they are substantially higher than what the companies are making today versus, let's say, metal companies. And on those high consensus estimates, the stocks are trading at cycle high valuation multiples. So it is just that risk reward does not stack up well for cement unless one makes the assumption that coal prices are going to collapse from here, commodity prices are going to collapse from here, which is not our base case.
Consolidation is happening in the cement sector. One large M&A deal, maybe more are coming. Could there be further consolidation in the cement sector leading to more pricing power? Pretty much we saw in steel is a function of consolidation.
Again, we'll not like to comment on individual companies. At this point of time, the way we are looking at is that the next 6 to 12 months are challenging for the sector given where costs are. And demand has not really been very strong, which has limited the industry's pricing power. And we maintain that view that for FY23, it would be the same. Steel is a global cyclical, and over there the pricing power has emerged because the largest exporter decided to decarbonize, and it's a structural change. China is just not going to come back to exporting 120 million tons of steel, what it used to do, and there is just not enough capacity to meet up for that lost supply. So I think the steel industry's changes are more structural in nature, which should keep on playing itself out.
Very interested to see how the steel prices move, because if you look at Russia and Indian steel, TC-borne accounts for 15 to 20% of the world's production, and that's going to go out to the market. So certainly very interesting times ahead for us. Thank you so much for joining us live today and decoding the entire metal pack that has got some of its sheen back, at least from yesterday in the trading session.